Hi, and welcome to Aldrich Wealth's fourth quarter investor update and market outlook. I'm Nicole Rice, partner at Aldrich Wealth, and I'm joined by Darren Richards, our chief investment officer and partner. Hi, Darren.
Hi, Nicole.
Let's start off talking about stocks. So we saw S&P 500 earnings exceed 20% in 2018, and GDP is projected to come in around 3%. That's both very strong indicators. However, we saw stocks log their worst quarter in over a decade, and the December decline was the worst in 80 years. So can you talk a little bit about why we saw that poor performance in 2018?
You bet. What a difference a quarter makes. So coming off 9 pretty good months in a row, all of a sudden fourth quarter rolls around and things change dramatically. So you mentioned the fundamentals were strong. So earnings growth in third quarter for S&P 500 companies, 25%, 3.4% GDP growth for the quarter. So these were both not only good numbers, but they were above expectations. So normally you would expect that to drive stock prices higher. That didn't happen. What really happened was sentiment just soured completely during the quarter. So the fundamentals, despite being very, very strong, emotions and sometimes when people feel uncertain about the market, that actually overrides the fundamentals. And clearly that was the case in the fourth quarter. So it started off in October. The Fed raised rates in September and indicated that they were indeed going to raise rates not only again in December, but 3 more times in 2019 and perhaps 1 or 2 times in 2020. So all of a sudden the market had been a little hesitant to kind of believe what the Fed was saying. They started to go, okay, you mean it this time. So we saw interest rates jump. So the 10-year Treasury, which started the year at 2.4, jumped all the way up to 3.23, 3.24 during the quarter, actually during October, and all of a sudden investors became nervous because higher interest rates generally push equity prices down, and that's what we saw happen. So very, very difficult start based on the fact interest rates jumped. Then Powell came out and said, well, rates are actually closer to neutral. And he gave the market a little bit of a reprieve in November. So we saw stocks go up a little bit. We saw interest rates start to come back down. So the market said, okay, maybe rates aren't going to go up as fast, and everything kind of reevaluated again. And then after the December rate hike, Powell's comment was a little bit more vague again, and the market became more concerned about interest rates. So was it going to be 2 hikes in 2019? Was it going to be 1? There was even some people pricing in a rate cut. So the interest rate environment went from up to down to confusing. And I think all of a sudden you had investors going, I don't know what rates are going to do, and I'm concerned about this. Check one. In November, the Democrats took the House. So you had a split government. You had a situation where gridlock traditionally isn't a bad thing. But really, when you have the Democrats and the Republicans as far apart as they are on issues right now, gridlock can turn into dysfunction. And what we saw was in December, dysfunction really came in. So the government actually had a partial shutdown, which is still going on today. It's the longest in history. So it was around the 20th of December that is when the government shut down. And there doesn't appear to be any movement toward an agreement, toward any of the shutdown. So government looks a little strange right now. We already knew there were issues in Washington, D.C., but this just exacerbates it. So we've got another issue on top of that causes uncertainty. And then lastly, the trade tariff. So I think a lot of people had factored in the tariffs were going to be resolved by the midterm elections. It would help the Republicans, and it would really kind of give them a push into the year. It didn't happen. And remember that President Trump said trade wars are easy to win. Apparently they're not so easy to win. So from an economic standpoint, we're seeing slower growth here. We're seeing slower growth in China. It's across the globe. So particularly in manufacturing, this trade war is impacting the global growth everywhere. It's not just China. It's really across the globe. So the fact that this didn't get resolved, and as we kind of got toward the end of the year, tariffs were supposed to go up. There was a 36 or 90-day reprieve that we gave, and we're still negotiating. But frankly, there's not really much understanding of how this is going to end. So it could continue to be a black cloud over the market. So great fundamentals. Government is having issues. Tariffs are still an issue. We're not sure which direction interest rates are going to go. And all of a sudden, that's what drove the market. So stocks, S&P 500 down 13.5%. As you mentioned, the worst December since 1931, going back to the Great Depression. Investors just sold out of everything. They really weren't picking sectors and doing anything other than just selling out of stocks, particularly risky stocks. So you saw growth stocks perform a little worse than value stocks. The only sector out of the 11 that was positive for the quarter was utilities. The rest were all pretty much down double digit. And energy was down 24% because energy prices were down 40%. So a very dramatic sell-off. Small cap stocks, which are generally more risky, were down 20%, bear market territory. Just a complete washout. Again, good fundamentals, but it was uncertainty and the investor nervousness that really drove the market in the quarter. And we saw the volatility index double. And investors were very nervous, and they reacted by selling.
Yeah, thank you for that. So you mentioned you were talking about trade wars. So let's switch over to talking about international versus domestic. So we saw that this last year, international actually underperformed domestic stocks for the first 3 quarters. And despite suffering heavy losses during that time, we actually saw then international outperform domestic stocks. So can you talk a little bit why we saw this outperformance in the fourth quarter of 2018?
Sure. International stocks generally outperformed the U.S. for 2 reasons. One, we had faster growth. So the tax cuts for 2018 kicked in, and our growth was faster here than it was across the globe. So we had an advantage there. At the same time, interest rates were moving higher in the U.S., so the dollar was strengthening. So money was actually coming to the United States because of the rising dollar, the faster growth, and the U.S. looked relatively attractive compared to the rest of the world. And you saw that, again, as you mentioned, for the first 9 months. And then when the sell-off occurred, the fact that international had lagged for so much of the year, their valuations were actually relatively low. So they were somewhat attractive from that standpoint. So when investors were selling risky assets, international equities weren't necessarily as risky as they might have been if they'd been kind of keeping pace. So they were selling what had worked well and really de-risking portfolios. At the same time, interest rates look like maybe they're not going to go up as fast. Global growth looks like it's starting to catch up with the United States. So some of the benefits that the U.S. Economy had are getting washed away. So all of a sudden, U.S. stocks don't necessarily look as attractive relative to international stocks. And keep in mind that a lot of these issues I talked about are domestic. The trade issue, the governmental issue, interest rate issues, these are more domestic issues. So a lot of the uncertainty that we saw kind of rear up in the fourth quarter was more focused here than it was overseas. And again, valuations are relatively attractive. The dollar's probably leveling out a little bit. So I think that's the reason. And emerging markets of all asset classes is generally considered to be the most risky. It was actually the best performing asset class. And I think, again, it was because it was so beaten up that it looked attractive, and some of the issues that are going on here may not impact emerging markets directly.
Okay, great, thank you. So now let's shift over into bonds. So we saw investment grade bonds actually have their best quarter of the year in the fourth quarter, with most of the gains actually coming in December. Was that attributed to, as you mentioned earlier, the Fed rate hike in December and the subsequent statement from the Fed, or was it really a result of the volatility and the falling equity prices?
I think with investment grade bonds, it was really the Fed's direction that drove the market. So as I mentioned, interest rates were 3.25 on the 10-year, or something like that, in October, and they slowly went down to end the quarter at 2.7%. So a pretty dramatic decline in yield, but it really matched expectations for Fed hikes in the future. So it wasn't necessarily that investors were selling out of equities and buying bonds and pushing yields down. It was more an issue of the rate hike path declined by about 50 basis points expectations, and that's about what we saw investment grade yields come down. So pretty much in line. Now, on the other side, investors were very nervous, and they were selling out of equities, and they were moving into money market mostly, which is an indication not that they're concerned about future growth, but they're just concerned right now. So money market is a holding place, basically. Think of investors putting their cash there and saying, once the dust settles, I'll know what to do with my money, so I'll put it here. So they weren't necessarily buying 10-year treasuries and things that you would do if you were so nervous you thought a recession was coming. They were more just parking money on the sideline. But the sell-off that led a lot of money to leave equities also impacted areas of the bond market that are more aggressive. So high yield, for instance, had done quite well. Spreads were very, very tight, so investors were willing to pay quite a bit for yield. That reversed dramatically in the quarter. Floating rate bonds do well when interest rates rise. We saw that reverse in the quarter. So that was more associated, I think, with the sentiment souring, whereas I think the investment grade bonds was just an issue of they're following the Fed path down, because rates are already so low that buying bonds, it's a little bit defensive, but it's not necessarily a great way to place money for the long term.
Okay, great. Speaking of long term, I'm going to ask you now to get out your proverbial crystal ball. And, no one can predict what future economic events will happen, or market conditions, but I'm sure our clients really want to know, what is your outlook for 2019?
Yes. So I'm expecting stocks to do quite a bit better in 2019. That's not really going on a limb. They had their worst year since 2008. But nonetheless, it's very uncommon to have stocks drop 2 years in a row. Very uncommon. So that's just one thing you can kind of hang your hat on. But valuations started the year relatively high, and they ended the year below average. So we saw a dramatic decline in equity prices. At the same time, we saw earnings jump 20+%. So pricing of stock, what investors are willing to pay for earnings, has come down quite a bit. It's actually below long-term average. At the same time, interest rates are still fairly low. So generally, when interest rates are low, investors are willing to pay more for stocks. So if you just kind of look at that backdrop, you would say, well, stocks should perform fairly well. If valuations normalize, we should get pretty good returns. At the same time, I don't expect a ton of return in bonds because interest rates, as I mentioned, are low. but I think the Fed's going to increase rates very, very slowly over the next year or so, if at all. So rates probably will move a little bit higher, but not dramatically. So you'll get some return out of fixed income, but really equity looks more attractive right now than what we're seeing for bonds. International equities look attractive for some of the reasons I mentioned. The fact that the dollar is probably going to weaken a little bit this year after strengthening in 2018. U.S. growth is kind of converging with the rest of the globe. We no longer have a head start associated with the cuts. And valuations are extremely low in international equities. So I wouldn't be surprised if we saw a rebound in international relative to domestic. Buckle up, the volatility is still here. These issues that I mentioned with the government, with tariffs, with the Fed, they're going to stick around for a while. And we saw oil prices drop 40% in the quarter. Some of these things are really unnerving, and I don't think they're all going to go away all of a sudden. So fundamentals still look very, very solid, but we do have some of these headwinds that are going to cause trouble, and we're going to see volatility. We're going to have those up and down days that are a little bit unnerving, but overall I think the market should hold up fairly well, particularly I think again on the international side of things, but it's going to be a bumpier ride.
Thanks. So it sounds like patience is the mantra for 2019.
Patience is definitely the mantra. Keep in mind that oftentimes the best performance falls right on the heels of the worst performance. So from a sentiment standpoint, you go through a December like that and you feel awful about things. But oftentimes that's when the market overcorrects to the downside. The fundamentals have been tossed out the window. Everyone's concerned about issues. Imagine what happens if we do strike a trade agreement with China and all of a sudden global growth picks back up again and equities are trading on the discount. If the Fed only does one rate hike, maybe next year, stabilizes things, we have still very, very low interest rates. That should help the economy globally and particularly in the U.S. And, if we can get this government shutdown to end and maybe shake hands once in a while between parties, I think, again, that would be something that could really push the market higher.
Great. Thanks, Darren.
Thank you.
And thank you for joining us for Aldrich Wealth's fourth quarter investor update and market outlook.